People think the dollar is the cleanest, dirty shirt in the hamper. I don't think so. I think it's one of the dirtiest shirts. Just that it's supported by its reserve currency status. Once it loses that status, it's going to expose the inherent weakness of the currency. You can't have trillion-dollar trade deficits every year. You can't have a service sector economy without production and manufacturing. That has to be the base of it. You can't have a consumer-led economy. It has to be led by savings and investment. You can't say, well, it's all about spending. It's not. Spending is the reward for production. Our model only makes sense if we're the reserve currency. So this dynamic can't go on forever, and it won't go on forever. But when it ends, it's going to be catastrophic, especially for the people who are not prepared, which is just about everybody.
Hey guys, welcome to Capital Cosm. Today we've got the one and only Peter Schiff on the show. Peter, thank you for coming on, my friend.
Oh, well, thanks for inviting me on.
Yeah. As always, Peter, the thing that I like to ask all my guests is their origin story. What got you into investing? What got you into gold and silver, precious metals, commodity investing, all of that? Kind of run us down through memory lane and tell us about your origin story there.
Well, I got into the profession out of college. I finally got out of Berkeley in 1987. I started in 81, but I took a couple of years off and so graduated in 87, and I kind of went right into financial services as a career. But it didn't take me long to kind of venture off on my own. I found out I was more of a square peg in a round hole, in traditional, wirehouse Wall Street firms. And I started my own BD in the mid-90s and then built it up from there. As far as my interest in gold, that started at an early age. In fact, when I was bar mitzvahed at 13, I took my bar mitzvah money and I bought a bunch of gold. And that would have been in 1976 or so. And then I sold it in 1980 when, gold was up near the high. Not so much because I was a great trader. I just wanted to buy a car. And so that's where I got the money. So, I think I about tripled my bar mitzvah money, and then I bought a car. But, that was the end of the last big gold bull market, right? 1970s, where gold went from 35 to 800. And the gold stocks, just made fortunes for people who bought them. I think we're at the early stages of a repeat of the 70s show when it comes to gold and gold mining stocks. Only I think, unlike most sequels, this one's going to be better than the original. As far as I think people are going to make even more money in gold and mining stocks now than they did in the 70s. And wow. They made a tremendous amount of money in the 70s. So I think, it's even going to be a more powerful trade with an even bigger payoff for the people who are in it.
Yeah, those are pretty big words to say, considering gold is at 2,300 now. To outdo the 70s, where you went from, like you described, to a 30x in the gold price. That's pretty astounding if that's the case.
Yeah, well, if you think about where gold peaked in 1980 timeframe, it peaked at around the Dow equaling 1 ounce of gold. Gold got to 800 and the Dow got to 800. And that's about where the Dow bottomed in 1932 as well, when the Dow was down around 1 ounce of gold. So if you figure that we could make it a hat trick and we can see gold and the Dow being close to equal again, well, unless you think the Dow is going to completely implode by 90% or more, the only way you can get to that kind of parity is if the gold price goes way up. So maybe the Dow can go down from, almost 40,000, where it is now, high 30s. But maybe it can go down to 20,000, which is not, outside the realm of possibility. And if gold were to go up to 20,000, there you go. But 20,000 gold is almost a 10x increase from where it is now. But that's not that much. Gold was under 300 in 2000. And it was almost 2,000 in 2011. So gold can have very big gains. It's done it in the past. And if you look at where gold is now in relationship to where it was when the Federal Reserve first came on the scene in 1916 or 1913. Or is it, yeah, 16,
13.
with the income tax and the Federal Reserve, right? Or
I
1916.
thought it was 13.
Or was it 13?
Yeah.
Yeah, all right. I mean, I something like, yeah, well, but anyway, but whether it's 1913 or 1916, gold was $20 an ounce at that time. So it's more than 100 times the price that it was back then. Looking at it the other way around, it means that U.S. currency has lost more than 99% of its value during that time period. And the lion's share of that loss happened, since the 1960s, right? Because but I think it's going to really start to accelerate in the years ahead. I think, the amount of purchasing power the dollar is going to lose. We've just got a small taste of that with the spike in inflation over the last, few years. But this is just the beginning. I mean, it's not the end of it, like the Fed claims, hey, it's all over, the worst is behind us. They said that in 1972, 1973, right? They thought inflation was over back then because it came down from 6.9% in 1969 to like 3.5% in 1971, 1972. So they thought that was it. And the next thing you know, it was double digits. And so I think we're in a much worse position now when it comes to how bad inflation is going to be, because we're in much worse fiscal shape than we were back in 1970. The amount of inflation in the pipeline is much greater. I mean, the deficit spending of the prior decade dwarfs what happened under LBJ during the 1960s, where you had Vietnam, the war on poverty, Great Society, going to the moon, all that stuff, guns and butter, budget deficits. That laid the foundation for the 1970s. Well, what's happened since the 2008 financial crisis with QE 1, 2, and 3, COVID, QE, all that, has laid the foundation for a much bigger inflationary explosion. And it's happening when the U.S. is in much worse shape. We have debt to GDP of 120%. We've got $1 trillion a year trade deficits as far as the eye can see, $2-3 trillion a year budget deficits. Not only as far as the eye can see, but as far as the eye can see, the deficits get much bigger than that and not that far out. We're already spending over $1 trillion a year on interest on that debt. That's more than we spend on national defense. A year from now, it'll be $2 trillion. So interest on the debt will be greater than Social Security or Medicare. It'll be the number one line item in the federal budget. And then it'll keep rising from there. So clearly a fiscal crisis is coming.
Okay, so a few things I want to kind of pinpoint on what you just talked about. You talked about the inflationary cycle in the 1970s. We had 3 humps back then. If you look at a year-over-year inflation chart, you'll notice 1, 2, and 3. Why was it that the inflation numbers kept rebounding up and down? What was kind of like the process there to elicit
in the 70s?
Yeah.
Well, again, nothing goes in a straight line. So prices can spike and then they can calm down a bit. Remember, they never went down. They just didn't go up as fast. And then they accelerated and went up faster. But what's important is the trend. As an investor, I mean, you see a stock, it's in an uptrend. I mean, there's going to be plenty of pullbacks. It doesn't mean the uptrend is over. It's natural. I mean, it would be unnatural for a stock to go back up every day and never go down. So it's healthy to see some type of correction. And so that's what we saw in the early 70s, was a correction, not a return to low inflation, but just a correction, on the road to higher inflation. And that's exactly what we experienced recently. Because what happened is when the Fed raised interest rates, started hiking rates from 0 up to 5%, the market started to front run that, and the dollar strengthened. That brought down gold, that brought down commodity prices, and that helped bring down the CPI. But what happened ever since the Fed stopped hiking. Oil prices are up dramatically this year, 20-30%. The CRB is up almost 20%, versus last year, oil prices dropped 10%. The CRB was flat. And with that, we had over 4% inflation, the way the government measures it. So 2024 is going to have much worse inflation than 2023. So we're headed back in the wrong direction. I mean, the Fed has taken a premature victory lap, claiming that inflation is on a glide path down to 2% and they can start cutting rates. No. In fact, gold is telling you that that's not going to happen. That's why gold hit 2,400. It got to 2,416, was a new all-time record high. That surge in the price of gold was a warning that Fed policy is too easy, that not only shouldn't the Fed be cutting rates, but they should never have stopped hiking. They stopped too soon. Rates need to go higher. And the proof that rates are still too low is borrowing is still too high. Consumer debt is at an all-time record high, credit card debt record high, government deficit spending record high. Nobody is slowing down their spending because the Fed has raised rates. That's because they haven't raised them enough. Because that's the only way that you fight inflation with rate hikes, is if those rate hikes are effective in reducing borrowing and spending. And they also have to encourage more savings, because that's also how you fight inflation, with more savings, because that fuels capital investment, which helps to increase supply. So higher rates reduce demand and increase supply, and that cools off prices. But we're not getting that. We have savings near record lows, and manufacturing in the U.S. has been in a recession for a couple of years. So all the ingredients are there for an explosion of inflation. But, Wall Street is asleep. They don't get it. Even today, Newmont reports better than expected earnings. The stock's up 14%, one of its biggest single day gains. And you don't even see any spillover really into the rest of the sector, which is still way overdone. It was just a couple of months ago that a big Wall Street firm, or not a big one, but one of the few ones that covers gold stocks, basically put a sell on Newmont. They reduced it to a hold, and it's up almost 50% since then. But the reason they said we're putting a hold on it was because they saw no upside in the price of gold, and then gold spikes up 20%. But Wall Street still doesn't know enough to buy these stocks. They still don't get it. They believe the Fed. I don't know why. First they said, they said inflation was transitory. That was wrong. Back in the day, they said subprime was contained. That was wrong. The Fed is never right. So I don't know why investors put any stock in what they say. They have a political agenda that motivates what they say. They're not, talking about what's really happening. But they're in a box. Stagflation is real. The economy is headed back to recession if we haven't already been in recession for the past year or more. We probably have, just that the statistics are not accurate and are being misinterpreted. But at some point, the Fed is going to be forced into going back to QE and probably cutting rates because of weakening economy and a weakening labor market. And they're going to do that with strengthening inflation. And that's the game over for the Fed, because then the bottom's going to fall out of the dollar. And inflation is going to go through the roof, and we're going to have a currency crisis and a sovereign debt crisis that will make the 2008 financial crisis look like a Sunday school picnic.
Yeah, but at the same time, what can the Fed actually do with just raising or lowering rates? When you really think about it, this inflation comes from the supply side, right? It's cost push inflation from the commodity sector, and no, you don't.
There's no such thing as cost push inflation or demand pull. There's only one kind of inflation. That's when the Fed expands the money supply. Or the credit, right? Inflation is an expansion of money and credit, and that comes from the government. It's coming from the Federal Reserve. But yes, there are supply problems, and there should be a reduction in demand commensurate with the limit of supply. But we did the opposite during COVID. We actually orchestrated a huge reduction in supply by telling people not to work. And then we increased demand by mailing everybody who wasn't working a check that was bigger than the paycheck they earned when they actually were productive. And so that was a cocktail for massive inflation, which I called out in real time when we were dumb enough to implement that policy. But what the Fed could do is raise interest rates high enough to really bite into spending. And that maybe that means 10% interest rates. But at some point, people aren't going to be able to borrow on their credit cards anymore because the banks won't make the loans, because they won't be able to earn enough to offset the losses. And they have to raise interest rates to the point where the government has to cut spending because it can't afford to finance the debt. But the Fed doesn't have the political backbone to do that. Right? For all the talk about how independent the Fed is, they're not independent at all. In fact, Powell won't even criticize Congress. He won't criticize Biden. What good is it of having an independent Fed if they can't criticize the government when they're acting recklessly and irresponsibly? But he won't criticize the deficit spending. And unlike Paul Volcker, who actually beat inflation, he was extremely critical of the government and deficit spending all the time. He was on his bully pulpit demanding spending cuts or tax increases or something to offset the deficits. But Powell says, hey, we take it as it comes. We don't really care what the fiscal policy is. I mean, how can they not care? Because if you're going to have this big deficit spending, you ain't fighting inflation unless you really get tough, which Powell's not doing. I mean, these are mamby-pamby rate hikes. Rates are at 5%. I mean, before the 2008 financial crisis, that was just average. But you're not going to fight inflation with those kind of rates. I mean, Powell keeps claiming that Fed policy is restrictive. It's not restrictive. There's no evidence it's restrictive. Stock market hit new highs. Borrowing hit new highs. He's still stimulative.
Yeah. So can raising rates also impact the supply side due to the increase in capital expenditure? Like these,
if rates are higher, people are going to save more and spend less. That's going to increase supply because A, there's less demand, so there's more stuff because there's not as much buying because people are saving. But the savings can then be loaned out to businesses to make capital investments that will increase the future supply. But none of that stuff is happening because the rates are still too low. And, as far as I'm concerned, the rates are still negative because the real inflation rate is above 5%. Yeah. Even though the government's CPI says it's 3.5 or something like that. That doesn't tell the whole story. You have to double whatever the CPI is to get something that approximates the actual inflation rate. So if the government says it's 3.5, it's 7. If inflation is 7 and interest rates are 5, that's still negative 2. People are being paid to borrow, so why wouldn't they do it? And no one's going to save. Why save money if it's just going to lose value the longer you hold on to it?
Yeah. So you look at like metrics like shadow stats, for example. I mean, they typically have the inflation rate about double what the reported rate is, which is 3.5% today. You take a 2x, you slap a 2x marker on it, that takes you about 7%.
Look, I just did an easy experiment myself, like 10 years ago in 2013. You can still see the video up on my YouTube channel. But, I didn't believe that the inflation numbers back then. So I just happened to notice that in 2013, the government said that over the last 10 years, the cost of newspapers and magazines rose by 30% total over 10 years, which would be about 3% a year. And I was like, oh, really? Let me just go and check, because it's pretty easy to check. You just go on the internet and you go to, 2003 Time Magazine, Wall Street Journal, U.S. News and World Report, Business Week, New York Post. Just look at the newspapers and magazines from 10 years ago and look at the price that's like written there, right? Because it's right on the front page. So I compared the prices that were written on the covers of newspapers and magazines in 2003 to the prices that were written on those same magazines on the same covers in 2013 and looked at the increase. The actual increase in price wasn't 30%, it was 130%. So how does that happen? How do you put 130% increase into the CPI, yet only 30% comes out the other end, and 100% just disappears, right? That's the magic of the CPI. It makes inflation disappear, right? But, and if that's the case with newspapers and magazines, everything is being underreported. And this is by design. The government wants inflation. They create inflation because it serves their purposes. They just don't want people to know how bad it is, right? Because they want to keep doing it.
And that's through the process of substitution and things called hedonic adjustments, correct?
Yeah, and substitution and just hedonics and all the different gimmicks that they've introduced. They didn't have those gimmicks in the 1970s. That's why it's never an apples to apples comparison. When they say, well, the inflation is not as bad as the 1970s, yeah, it's actually worse if we measured it the same way that we measured it back then. They did the same thing with unemployment. If we still measured unemployment the way they did, back then, it'd be well into the double digits. So we probably have double-digit inflation, double-digit unemployment right now. The misery index is off the charts. That's why Biden and Harris are the most unpopular president, vice president in U.S. history, or at least the history of popularity polls. Why are they so unpopular? Because the economy stinks and they're getting the blame, right? That's the reality. look behind all these rosy smoke and mirror statistics. The voters tell you how bad the economy is. It's the economy, stupid. That's why Biden is doing so poorly. He's doing worse than any Democrat in modern times, certainly since Franklin Roosevelt. He's doing worse with African Americans than any other Democrat. Trump is going to get a record amount of African American votes. Why? Because they're disproportionately hurt by this lousy economy. And so they're blaming it on Biden, and they're hoping that Trump can do something different, because they know that if it stays the way it is, right, there's no hope, right? It's just going to keep getting worse. So they're going to take a shot and vote for Trump.
Yeah, and here's a real head scratcher. I mean, they're trying to pass this capital gains legislation in an election year. And, they're talking about things along the lines of a 44% capital gains tax, increase the capital gains to that much. But even worse, a 25% unrealized gains. So, I mean, that is what, okay, first of all, what are the ramifications of an unrealized tax?
Well, first of all, it's unconstitutional, because if you haven't realized the gains, you don't have any income. You see, the 16th Amendment only authorized the government to tax income without regard to apportionment, not property. Because if you're going to tax an unrealized gain, you're taxing the property. It's basically a direct tax on property measured by the appreciation of the property. But if they want to do that legally, they'd have to apportion it, which they can't do, and they're not going to do. So it's unconstitutional. But think about it from a practical perspective. If you don't sell your asset, you don't have any income. You don't have any cash to pay a tax. If I buy a stock and then sell it, and I've got money, I could take some of that money and pay a tax. But if I haven't sold it, I don't have any money. How am I going to get the money to pay the tax? I'd have to sell the asset, which may impact the price. In fact, if I'm a CEO of a big company, and is publicly traded, and I own 10% of the stock, and I have to sell a big chunk of it to pay a tax on my unrealized gains, I could crash the market. There may not be any unrealized gains by the time I'm finished selling. But what about when assets aren't liquid because they're not publicly traded? We have to do an appraisal every year. You got to appraise the value of your small business, the value of your real estate, some collectibles that you have, and then you got to calculate if they may have gone up in price, and you got to pay a tax. I mean, it's not even a gain, right? There's an old expression from gambling: don't count your chips while you're sitting at the table, right? I mean, how many times did you buy a stock, it goes up, and then before you sell it, it goes down, and you end up with a loser, right? I mean, it's just a snapshot in time. It's not a real gain until you realize it. I've been at the casinos many times. In fact, probably every time I go to a casino, I'm ahead at one point, but I'm usually, down by the time you leave. You leave because you run out of money. But if you're winning, you keep playing because you're having fun. But, you can't just keep score temporarily when you're ahead. So this is an illegal tax. It's a bad tax economically because it ends up taxing capital, taxing savings, destroying wealth. So hopefully, the court strikes it down. The Supreme Court had an opportunity. They should have taken it to nip this in the bud, to get rid of any kind of wealth tax or unrealized gains tax that's trying to be slipped through the Constitution by pretending that what's being taxed is income. But it's not income if I haven't realized the gain. It's just a tax on my property. It's a tax on the asset. You're just measuring that tax based on some appreciation, but it doesn't change the nature. It is a property tax. It is not an income tax. And it's long settled, multiple Supreme Court cases. Property taxes are direct taxes, and they need to be apportioned. The 16th Amendment doesn't authorize a unapportioned direct tax on property, only income. And that means the government just can't redefine income so it can put other things into that tax that are not there. It's a legal definition of income. That's why the Internal Revenue Code doesn't even define income. It defines gross income in Section 61, but it never defines income because it can't. The Supreme Court has to define income because the government, the Congress, can't define it because it's a constitutional term. And if Congress could define income, they could just change the Constitution by changing the definition of income. They can't do that. Income has a specific meaning, and the courts have already decided what that meaning is 100 years ago. And it's realized gains, right? It is not appreciation in an asset that you own. So, it's unconstitutional, but it's bad economic policy if they do this. It's going to be very destructive to our economy, to our capital markets, to corporate America, to small businessmen, to entrepreneurs. I mean, a lot of business would be destroyed. They'd have to be liquidated just to pay the tax. I mean, you have a small business that's maybe been in your family for a long time, and now all of a sudden you got to pay some kind of unrealized gain on the value of your company. And of course, they try to say, oh, this is just for the millionaires and billionaires. Yeah, that's what they told us when they passed the income tax in 1913. It was only for the Rockefellers and the Carnegies and the Vanderbilts. There wasn't even a payroll tax until the Second World War. I mean, nobody paid the income tax. And the first rate, the max was 4%. That was the highest it got. But as soon as they passed it, they started jacking up the rate, and then they started roping more people into it until now, you've got middle-class people paying the income tax. But when they were, trying to campaign for the income tax, they actually said that it will result in lower taxes. They said that, hey, we'll get rid of the tariffs, which the average guy is paying. If we can only have an income tax, we won't have to have tariffs anymore. Right? So we can get rid of the tariffs. We'll just make the billionaires pay this little tax, and no one else has to pay a tariff when they buy something. So it was all BS. The American public got suckered into it, and now we're stuck with it. And now they want to do the same thing with this kind of unconstitutional wealth tax, because if they ever get away with it and it's there, it won't be long before everybody is being trapped by it. And inflation, of course, is going to make everybody richer on paper, not in reality. But as everything is, set higher, what it means to be a millionaire, maybe everybody will be a millionaire. Maybe the billionaires will be trillionaires. The millionaires will be billionaires, and then the middle class will be millionaires. And you want to know, they'll be hit by the millionaires tax, right? Because it's gonna ensnare everybody in its net. But that's one of the reasons I live in Puerto Rico. I got zero capital gains tax, so none of this is going to affect me as far as my taxes. My taxes are staying at zero no matter what these guys do. And I'll probably have even bigger gains because all this is inflationary, because it's destructive to economic growth. It's going to reduce the supply as the government continues to stoke demand. And the one thing it probably won't do is raise a lot of revenue, because it will destroy wealth. It will destroy economic activity and probably backfire and result in less revenue.
Yeah, I mean, to me, it sounds like this is just red meat being thrown at the progressive base, because I just can't imagine why you would do this in an election year. I mean, if you think about the incentives of this thing, if I'm
first of all,
investor, yeah, go ahead.
It's probably not going to pass because the Republicans aren't going to go for it. So I can't see it passing in the House. And I mean, the votes that they're trying to attract with this are not the ones that are going to pay this tax. So it's don't tax me, tax the person behind the tree, right? Everybody is fine with taxing somebody else as long as they're not taxed. And so, all they risk alienating are the millionaires and billionaires, right? So how many votes are there, right? It's Willie Sutton. Why do you rob banks? Well, that's where the money is. Well, where are the votes? It's the middle class, right? That's where the votes are. So you promise taxes that aren't going to affect the middle class. You say, hey, let's take money from these rich people who don't even deserve it. I mean, don't even need it. They don't deserve it. They're greedy. They're not paying their fair share anyway. So let's tax them. And then we could use that money to pay for programs that benefit you, right? That'll make your life better. And people fall for it. People get, they buy into this nonsense. So they may never even do it, but talking about it is what they think will win them votes.
Yeah. I mean, being rich is a constantly moving target. I mean, I remember back in 2016 when Bernie Sanders was giving these speeches about the millionaires and the billionaires. And then come 2020, he became a millionaire. And then his speeches all of a sudden started revolving around the billionaires. All of a sudden, the millionaires were absent from his speech because he became a millionaire. So it's always the person that's making N+1 dollars than you are, right? It's always, the class right above you that's rich, but you're never rich
Yeah, well,
yourself.
that's the class warfare. As long as it doesn't impact you, then you're in favor of the tax. And it's kind of like the draft. Once you become ineligible, maybe you're all for the draft. Although maybe you have some kids that might be drafted, but most kids that are of age of the draft, no, they're not gonna. They don't want the draft because they're the ones that are going to get drafted. But when you have no chance of being drafted, or you have connections, because the people have good connections, they didn't have to show up. They got all kinds of exemptions. People pulled strings. But people are voting in their own interests, and that's the problem with voting. That's the problem with democracy. I mean, the founding fathers knew that, over 200 years ago. That's why they created America as a republic. That's why initially there were all sorts of limits on who could vote. They didn't want everybody voting because they knew what they would vote for, and they were right. They vote for all this nonsense, and so that's why they said democracies are as violent in their deaths as they are in their births, because they vote themselves into bankruptcy, and that's exactly what we've done. We have the government that we voted for, a reckless and irresponsible government that robs from some people and gives to the people who vote for them. And now we're teetering on the brink of a complete economic meltdown, a sovereign debt crisis, a currency crisis. The economy is a mess because of generations of this type of politics.
Yeah, I mean, I know you live in Puerto Rico there. You guys may not have a seat at the table when it comes to the electoral vote, but at the same time, you effectively pay zero income tax. And, when push comes to shove, I'm sure a lot of people would trade having the ability to vote over having good government.
Oh, everybody,
Yeah.
every state would trade places with Puerto Rico in a heartbeat. You know, and when I gave up my right to vote, I lived in Connecticut. I always voted for the loser. I mean, no matter which congressman, I voted generally Republican. I mean, my heart was libertarian, but I knew they had no chance. So I would vote Republican as the lesser of two evils, but the greater of two evils always won. So my vote was always canceled out by some moron. And so, what did I give up by giving up my vote? I gave up nothing, right? Voting for the loser? Who cares? So now I have no representation, but I have no taxation. I mean, I have some, right? I pay taxes in Puerto Rico. But I don't, and I pay some taxes in the U.S., but only on a small part of my income. The bulk of my income, I don't pay any U.S. taxes on because I don't have any U.S. tax liability because the income is Puerto Rican sourced.
Yeah. Yeah. I mean, all of this talk about increasing the capital gains and, this skyrocketing inflation, it reminds me of this Lenin quote where he said, we will ground the bourgeoisie into dust by hitting them with inflation on one side and taxation on the other side. And it just seems like that's what's happening today.
And inflation is just another form of taxation. It's just more insidious, because it's not obvious. But it is a tax because it's the government that is creating the money and spending it into circulation. And so they're taking your purchasing power. With legitimate taxation, they take your money and spend it. With inflation, they take your purchasing power and spend it. But either tax leaves you with less purchasing power. So you have less goods and services because the government either taxed you or raised your prices, one or the other.
Yeah. So let's take it back to gold for a second now. Gold sitting at 2,300. It had a huge rise to 2,450, making all-time highs. We were at a point where we were making all-time highs on the daily. So we've come back a bit. And I know this is healthy. What's your take on the general gold market at the moment?
It's going way up. I mean, I couldn't be more bullish. The fact that this rally is happening in absolute obscurity, the fact that U.S. investors have been net sellers of GLD all year. I mean, when does that happen? They normally buy when the market's, rising, and they sell when it's falling. But now they've been selling into the rise. Are they geniuses? Were they able to pick the top? I don't think so. I don't think they're anywhere close. So I think the public doesn't get it. Wall Street doesn't get it. I said, they just downgraded Newmont a couple of months ago. It's up 50% since then. Nobody's upgraded it. Nobody's upgraded anything. The only mining stock that's got an upgrade in this year that I know is Freeport-McMoRan. Somebody put a buy on that. That's more of a copper stock than a gold stock. I mean, I like it. I own that one too. But all these mining stocks, I think, are super cheap. I think that the people that own them are going to enjoy spectacular gains. Half of my own portfolio has been in these stocks for a decade or more. And so it's been a mistake because I was early, but that mistake has allowed me to increase my portfolio rather substantially. So I have a lot more money in gold stocks now. I have a much bigger bet than I had 10 years ago. So if I'm right now, I'm just going to make so much more money than I would have made had I been right earlier. So, I'm fine. I had this opportunity, and so did my clients. But, it's not too late. These stocks, as far as I'm concerned, it's like they're in a Cracker Jack box. You're getting them for free. How much higher I think they're going to go from here. So I think, I've got a gold fund, the Euro Pacific Gold Fund. EPIGX is the no load symbol. People can buy that at any discount brokerage house. It's managed by Adrian Day. I think we've got a phenomenal portfolio of gold stocks, especially the junior miners. We have a kind of like a strategy of mixing the royalty companies, which are lower risk, with the higher risk more junior companies to balance it out. But I think we're in great shape for this bull market, which I think is early days. So I think people should just load up on these stocks if they've got the risk tolerance. But, I think the upside potential dwarfs the downside risk. So if you're going to bet on anything, this is where you want to put your speculative money into these mining stocks. So, and if you want to learn more about it too, you can contact my reps at Euro Pacific Asset Management at europac.com. And also physical gold and silver, still very cheap, especially silver, which is still under 30 bucks. It got to 50 bucks in 2011, which equaled the high in 1980. And we've already seen explosions. Look what's happened to coffee prices. Look what's happened to cocoa prices. I mean, one by one, these commodities are going ballistic. And, this is, again, a leading signal of higher inflation to come. But gold is just starting, and I think silver is about to explode. So you can go to Schiff Gold, that's my gold and silver company, to get some physical precious metals. Everybody should have some savings in gold and silver. Very few Americans do. The buyers have been in China. They've been in India. The Americans have been too dumb to buy. They've been buying, Bitcoin or some other crypto. They've been selling their real gold to buy fool's gold. And the other big buyers have been foreign central banks, emerging market central banks in the East. That's who's been buying gold. You think these guys are dumb? No, they know what they're doing. They can see the dollar's demise coming because they're part of it. They're part of the de-dollarization process. They want to get rid of dollars, but they have to buy something with their dollars to get rid of them. They're buying gold. But they're not buying the euro. They're not buying the yen. They're buying real money, right? They don't want another fiat currency trying to back up their currency. They want real money. And so the process has started. So you can either, get crushed by it, or you can, take part in it. But there's not that much more time, I think, to really put the trade on, because I think once Wall Street wakes up from this sleep and more people recognize what's going to happen, it's just going to be a mad dash to buy these stocks, and just the prices are just going to go straight up because there's just not the supply. It's such a tiny little sector. Gold mining. I mean, the whole market cap of the entire industry worldwide, I don't even know if that would make it into the the top 50 companies in the S&P. I was joking. One day Nvidia's its gain in one day more than exceeded the entire gold mining industry combined.
Wow.
So not the market cap, just the increase in the market cap in a single day. So that gives you an idea of what you're dealing with. And if you've got, in pension funds, endowments, hedge funds, retail investors, all of a sudden taking an interest in a sector they've had no interest in, for 10, 20 years, just imagine what's going to happen to the price.
Yeah. Gold miners super cheap compared to the metal itself. But what about the notion that most of the work being done on the miners typically comes from from a handful of companies, your Newmonts, your Barricks, et cetera. And the rest of these companies, these mining companies, are more or less lottery tickets. You might have a few that'll 10 bag along the way, but a lot of these guys are just going to lag behind. And so,
yeah, well, that's why you got to hire somebody like Adrian Day. There's an old joke that what's the definition of a gold mine? It's a hole in the ground with a liar standing next to it. So, Adrian knows, how to separate, the landmines from the gold mines. looking at these companies that actually have the capability to deliver the production. The Newmonts and the Barricks and the Agnico Eagles and, the bigger companies, they've been producing for a long time. They have the gold and they're getting it out of the ground. But there's a lot of smaller companies that are, have had a hard time raising money because no one believed in the market. And, a lot of the gold is expensive to get out of the ground. That's been the big problem that's been dogging these gold miners for more than a decade, is that they've been the ironic victims of inflation. Inflation has driven up the mining costs dramatically, but because investors don't realize how bad the inflation problem is and how much worse it's going to get, gold has actually lagged the cost of mining it. So a lot of gold companies are making less money today mining $2,300 gold than they did mining $500 gold. But I think what's about to change, and what it's already changing, it's already started, is that the price of gold is now moving up faster than the cost of producing it. And I think that's going to continue, and that means these profits are going to explode. But more importantly, is when you're a gold mining company and you have reserves, and analysts are trying to value those reserves and their future income potential. If gold is, let's say even 2,000 an ounce, but the analyst thinks that in 5 years it's going to be 1,600, 1,700, and he's looking at the costs and he thinks, well, the costs are going to keep rising, these companies aren't going to make any money. They're going to go out of business, right? The analysts are so negative on what these reserves are worth because they have such a pessimistic view of gold. They just think it's going down. Well, if they change their mind and they think the price of gold is going to go up, not down, especially more than the cost of mining it. Let's say I'm a gold company and I've got a big deposit of gold and it costs me $2,000 an ounce to mine it. Well, if gold is 2,000, 2,100, it's not even worth the risk of trying to dig it up, right? There's not enough money in there. Or, sometimes the cost of mining the gold is higher than the price. So you're certainly not going to dig it up. So that big deposit is valued at zero by the analysts. But let's say gold goes up to 3,000 or 4,000, and maybe the cost of mining that gold goes from 2,000 to 2,300, 2,500. But now you have a big gain. If I can mine gold for 2,500 and sell it for 4,000, I'm making $1,500 an ounce. Now multiply that by how many ounces are in the ground, and that's what my deposit is worth. Well, it went from being worth nothing to having maybe a multi-billion-dollar value. So what is that going to do to the stock price? It's going to go ballistic. So that's what happened to stocks in the 70s. So it's going to happen again. So I think the returns are just going to be phenomenal. It's just that Wall Street doesn't get it. It reminds me of my subprime short when we were short that market because, Wall Street firms were buying these securitized tranches of subprime mortgages that were rated, triple B minus, and they were buying some that had higher ratings than that. But I knew that these bonds were going to default and go to zero. It was just a question of when. But what didn't make sense to me is that nobody else knew that there were so many people who couldn't get something so simple that it was a real estate bubble and that prices were going to come down and that these mortgages were going to go to zero. It was obvious to me, but Wall Street was oblivious to it. But even after some of the big subprime lenders went bankrupt in 2007, the bonds weren't dropping. They were still trading at a premium to par. And, people were wondering what's going on here. Why aren't these things going down? And then all of a sudden they went to zero almost overnight. All the bids disappeared and people tried to get out and that was it. And so Wall Street can be very wrong about something and fail to see something that's very obvious until all of a sudden, a light bulb goes off and the emperor has new clothes. So I think that's going to happen with inflation and gold and these mining stocks. And so all of a sudden they're going to get it and you're going to see a violent move, except this time it's not an asset going to zero quickly. It's an asset going up multiples of its price quickly. The stocks are going to crash up.
Yeah. I mean, definitely a huge bullish case for gold. But I want to ask you this: is there any other commodity that you're more bullish on than precious metals?
Well, I think all the commodities, have a lot of growth. I'm not an expert on each individual commodity as to, does wheat or sugar or soybeans, or copper, or uranium or whatever. I think that inflation is going to drive all these commodities higher. I think during the years of easy money, we underinvested in commodities, raw materials, and resources, and too much money went into profitless companies that people were just trying to generate revenue to get a stock price that went up, and the real economy was starved of capital, and so we underinvested in plant and equipment. We haven't been opening up the mines and funding exploration and development. So there's going to be a big price to pay for that. Commodity prices are going to be very high for a long time. It's going to take a while to bring new supply onto market. And so inflation rates are going to be very elevated. I mean, that's just a reality. And people have to adjust their portfolios. If you didn't make the correction in the 1970s, if you stuck with what worked in the 60s, in the 1960s, they had the Nifty 50. That's when people made money in Polaroid and Xerox and companies like that could only go up, one decision stocks, and the market did great, but then we had the 70s, and the market peaked out in 1966. The Dow was 1,000 in 1966. It didn't get above 1,000 until 1982. So that was a lot of time. And during that time, we had massive inflation. So even though you got your money back in 1982, it wasn't worth anywhere near what it was when you invested it in 1966, right? But on the other hand, if in the late 60s or you put your money into gold and oil, I mean, oil went from $3 a barrel in 1970 to $30 a barrel in 1980. You could have made a fortune in oil. Gold, I already mentioned. The Japanese stock market went way up. You could have invested overseas stocks. The dollar went way down. In 1970, you got 360 yen of the dollar. By 1980, it was down to maybe around 150. You could buy a Swiss franc for 23 cents in 1970. By 1980, it was about 80 cents. So foreign currencies, foreign investments did great during the 70s. But if you stuck with what worked in the 60s, you got decimated. And I think that's what most Americans are going to do. They're going to stay with the NASDAQ. They're going to stay with the Magnificent Seven. They're going to, and they're going to go down with that ship. They're going to watch all their gains evaporate, which is a reason that you don't want to tax unrealized gains, because unrealized gains can become realized losses. And I think that's what's going to happen for a lot of investors. But the ones who are smart enough, the ones who are, following my advice, listen to my podcast, my clients, I think we're going to come out in great shape. Now, I have no idea what the government might do about raising our taxes, because, I think people will make a lot of money following my strategy, but I don't know if they'll be able to keep it. I mean, what if the tax rate goes to 90%? So who the hell knows what the government's going to do? But I know, I'm confident I know what the dollar's going to do and what gold's going to do and what foreign markets and commodities are going to do. So at least let's make the right investments, and then see what happens. But we got to at least get the investment strategy correct. I was early with the strategy. It's like I'm just doing it now. I mean, I saw this train wreck coming from a mile away because I understood it that well. And because I understood where we were going, I knew that we were going to get there a long time ago. I mean, I can see this coming. But now I also know that we're close. Just like I saw the subprime collapse happening years before it did. But then when we got really close, I was like, aha, finally it's happening. But even then, the Fed was like, oh, don't worry about subprime. It's contained. They didn't realize that, the extent of the problem. I realized it because I had been waiting for it for years. I had been predicting it for years. I understood exactly what was happening. But the Fed either didn't understand it or just wasn't being honest about it.
Yeah, I mean, I remember all those years. I mean, you were actually the person that got me into the, probably as with many others as well, to get me into the precious metal space. I remember listening to your podcast in the mid 2010s, and eventually I got into the commodity space as well. But you were kind of like the gateway to all of that stuff for me. I like how you mentioned that. I want to point back to when you mentioned that gold was kind of like a signal towards higher inflation. Well, we already saw that in 2020, right? So in 2020, you saw gold jump from 1,700 from the lows to 2,100, and only a year after did you start to see the CPI print begin to tick up. So, is this kind of a sign of things to come, much like it was back then?
Yeah, and the same thing happened with the run up in gold between 2000 and 2008. this inflation was picking up during that entire time. The only thing that stopped it was the financial crisis of '08. But commodity prices, were jamming. Remember, oil got to like $140 a barrel in the summer of 2008. The dollar was at an all-time record low in the summer of 2008. So there was a lot of inflation. What finally brought an end to it was the collapse in '08 and the Great Recession.
Yeah, yeah. Well, hey, I know we're coming up on time, Peter. I want to give you a chance to give out your socials. Where can people find you?
Well, I do my own podcast, The Peter Schiff Show. You can check me out at schiffradio.com. You can go to my YouTube channel, The Schiff Report. I do the podcast live once or twice a week, sometimes 3, but usually once or twice. So make sure and listen. Tell your friends, subscribe, to my YouTube channel, and follow me on social media. I'm on, all the usual suspects: Facebook, Instagram, TikTok. I mean, we'll see how much longer TikTok's around. YouTube, X, formerly Twitter, is where I spend most of my time on social media. I do a lot of posting there. Now I have over 1 million followers. There's a lot of engagement on my X site, so you should definitely follow me there and get involved in the conversation. It's all organic. I've never, purchased a follower. So the people that follow me are following me because they have an interest in what I'm saying, whether they agree with it or not. They want to hear it, and then they want to comment on it. So there's a lot going on there. So I would encourage people to follow me there. But most important, become a client. Become a client of my gold company at Schiff Gold, and get started buying some gold and silver. We don't rip anybody off. We don't push anybody into numismatics. We don't, charge high markups. We've got some of the lowest commissions online, except we're not even online. You actually can talk to a human being who help you figure out the right coins or bars to buy. So you should contact Schiff Gold. The website is schiffgold.com. And if you have a larger portfolio that you'd like me to manage for you, you should contact Euro Pacific Asset Management. You can roll over an IRA, a 401k. You can have a personal account. We'll manage it for you and build a portfolio. I said half my portfolio is in gold mining stocks and silver mining stocks. The other half is in value-oriented, dividend-paying foreign stocks. I think I've got a great portfolio. We get a lot of income. I think it's a good inflation hedge. So people should, look into this and talk about, with my reps. If you just want to do it yourself, I have 5 mutual funds. They're all available, no load. Schwab, Fidelity, all the big discount brokerage firms. You can buy all my funds. I've got the gold fund managed by Adrian Day. I've got a global value fund, a global dividend payers fund, an emerging market fund. I'm super bullish on the emerging markets, especially relative to developed markets. They did great again in the 70s. I think they'll do great now. And I have an international bond fund. So to the extent that you want to keep money in cash, I think it should be foreign cash. I think you're much better off with emerging market currencies and some of the other developed market currencies than the dollar. People think the dollar is the cleanest, dirtiest shirt in the hamper. I don't think so. I think it's one of the dirtiest shirts. People just haven't got a good whiff of it yet, but they will. So just become a client and follow me and encourage your friends to do so.
Interesting. Really quick. So do you think there's a cleaner currency out there than the dollar?
Yeah, I mean, I think the dollar is actually one of the dirtiest. It's just that it's supported by its reserve currency status. And so whenever there's a problem in Europe or Japan, people just buy the dollar, out of habit. And so we benefit. And so even though we're reckless and irresponsible, we're not held accountable by the markets. We will be. I think that day of reckoning will be upon us soon. But we've been able to rely on that crutch. And so that's why it looks like the dollar, is more resilient than it really is. Because once it loses that status, it's going to expose the inherent weakness of the currency. I mean, because we've built an economy that is completely non-viable. You can't have trillion-dollar trade deficits every year. You can't have a service sector economy without production and manufacturing. That has to be the base of it. You can't have a consumer-led economy. It has to be led by savings and investment. You can't say, well, it's all about spending. It's not. Spending is the reward for production. You have to produce before you consume. We have the economic cart before the horse. But our model only makes sense if we're the reserve currency. We have to be able to print money to buy the stuff that everybody else produces. And they have to be willing to accept that printed money. And we have to borrow what everybody else saves. And the rest of the world has to be willing to lend us that money, even though we can't possibly pay it back. So this dynamic can't go on forever, and it won't go on forever. But when it ends, it's going to be catastrophic, especially for the people who are not prepared, which is just about everybody.
Yeah. And what a way to end. So, guys, if you enjoyed this episode, be sure to give it a like, comment down below. Let me know if you agree or disagree with any of Peter's points. Subscribe to the channel if you haven't already to get more guests like Peter on the show. And with that said, I will see you in the next episode. Bye, y'all.
All right. Take care.